picks. Today we're having a look at a few names in energy, but more specifically power utility companies that specialize in natural gas distribution. Joining me with his top names to watch is Daniel Rich, Senior Equity Research Analyst at CFRA. Daniel, you have the power, quite literally. So give us a sense on what it is about this part of the broader utilities landscape that you think people should know about, first and foremost.
Yes, definitely. Good morning, John. Thanks for having me on, first of all. And, with utilities at CFRA, we recently actually upgraded our sector outlook to a market weight from an underweight, so more of a neutral position. There's a lot of positive trends that we started to see last year in terms of power demand rising in this country due to data centers, artificial intelligence, electric vehicles, and other trends that are really putting utilities more in the spotlight. Of course, there are a couple of high-flying names like a Constellation Energy and a Vistra that were high performers in 24 that are struggling a little bit more this year as broader momentum trades are under pressure. But some of the more traditional regulated names, like the few that I'll be speaking about this morning, we think there's a lot of positive growth opportunities in there.
Okay, well, let's get right to it then. There are three names that you came to the table with today. I'm going to start with PPL Corporation. Tell us a little bit more about this business.
Definitely. So PPL Corporation is really more of an electric utility. They do have some natural gas utility businesses as well. I think on the screen it's showing Pembina Pipeline. It's a common mistake where this ticker symbol is unfortunately the same, but it's an American company, PPL, based in Pennsylvania, and they have utilities in Kentucky, Pennsylvania, and Rhode Island. We really like the story on this name because it used to be more of a discounted valuation to peers because they had exposure to United Kingdom utilities that were more volatile. They got out of that business in 2021 and reinvested just in U.S.-based utilities. And you play where their earnings per share, there you go, that's the right chart right there. Their earnings per share and their dividend growth trajectory is probably going to be near the top of the heap when it comes to utilities. So that's probably about 7 to 8% annual growth for the next couple of years in terms of earnings per share and dividends. There's a lot of upside, we think, due to data center infrastructure building in Pennsylvania and Kentucky. And we think they have a lot of flexibility on the balance sheet, only about 54% debt to capital, below the 62% peer median. So we think that that's going to support the ability to grow that dividend despite potentially fluctuating interest rates or other business disruptions.
Okay, another name that you're watching is Centerpoint Energy, CNP, which I believe is based in Houston, but in terms of the areas they cover, it extends beyond that city.
That's correct. So Centerpoint Energy has a variety of utilities in terms of electric and gas exposure across primarily the Southeast and the Midwest, but it is based in Houston. And we think Houston's a very big part of their story. This is another higher growth potential play, we think, within the sector in terms of earnings per share opportunities. They are in the midst of a $21.3 billion CapEx program that should end this year, and then they're going to kick in another $26 billion or so CapEx program through the end of the decade. And we are expecting probably close to 8% annual earnings per share growth on a compounded annual basis from this year through 2028 as a result of the customer rate increases and authorized return on equity potential growth due to that CapEx spend. In Houston in particular, we saw last year with Hurricane Beryl, it was obviously a very devastating storm for that region. It exposed a lot of need, we think, for grid investment, for undergrounding power lines, managing vegetation, improving the technology to provide more safety. And we think that Centerpoint really gained a boost in its last rate case in Houston. They gained another $500 million in authorized CapEx spend to improve the infrastructure in Houston and saw a boost to the authorized return on equity in that region. So we think Houston's going to be a huge part of their growth play, just given the customer growth trends and the population trends that we're seeing moving to Texas right now. It's a hot area to be a utility.
Okay, and then the final one on your list, Atmos Energy, I believe, ATO?
Yes, Atmos Energy. So Atmos is a pure gas utility. No electric utility exposure here. It's the largest pure play gas utility in America. And this is based in Texas with exposure to some other areas. But Atmos probably is going to have perhaps the strongest what's called rate-based growth, the growth of their asset base that they can earn a return on in the coming years. They're guiding for 13 to 15% annual growth from 2025 to 2029, which should translate, in our view, to about 8% annual earnings per share growth over 2025 to 2028. We also think dividends will probably grow at around 8% clip as well. So very attractive growth potential here. Texas, again, is key for Atmos. This is a region that's seeing huge power demand expectations. Data center build in Texas right now is pretty tremendous. And so a company that's able to provide power, in this case via natural gas, to a lot of data centers is going to be well positioned. We also think that with the new Trump administration potentially cutting some of the emissions policies that we previously had and making it a little bit easier to drill for oil and gas, we think there's probably going to be a bigger need for infrastructure for natural gas pipelines and storage infrastructure. And we think Atmos will be right there to sort of benefit from those potential trends. Balance sheet, very healthy, only 40% debt to capital, again, supporting the flexibility, we think, to grow that dividend and support earnings per share growth over that period as well.
David, that's really helpful. Real quickly before I let you go, as you mentioned the Trump administration, and obviously we're navigating a trade war right now. You probably saw the headlines in Ontario, the decision to put a tax on power that's making its way into U.S. states. Is there a risk that the power industry just gets way too caught up in geopolitical tensions?
It's a risk, but I think it's a low risk. A lot of the U.S. power companies, a lot of these utilities are generating their own power, or they have contracts with power producers that are U.S. based. I suppose it's possible that some of the ones that are more Midwest or Northeast based, New York utilities that perhaps have relationships with Canadian power suppliers could be more in the crosshairs. But honestly, I think that the current rhetoric out of Washington is less harmful to utilities. It could be more harmful, I suppose, to some of the names I mentioned at the beginning of this call, where we're talking about Constellation, Vistra, names that are banking on economic growth, power demand, AI, data centers, et cetera. A potential war over tariffs that could slow economic growth in general, some sort of recessionary condition, that would obviously hurt overall economic activity, electricity demand, and so on down the line. So what we think, some of those more high flyers could be more at risk if you think this way. But the traditional regulated names that I've talked about, I think are safer.
Okay, David, thanks very much. Appreciate it. David Rich is with CFRA with those power names. The symbols, by the way, folks,